This is Chapter 1, Managerial Accounting. So, in my opinion, it's the most important if you have a business or you're thinking of starting a business. It's a great way to understand where your business is and where it could go using these tools you'll learn in this class. Financial accounting was the first step. To understand, you need to practice and use all the tools available. Email me if you need help. I love talking about this stuff. It is one of my favorite classes because it provides practical knowledge for a successful business. You need to understand financial accounting, the big picture of where you are, and managerial accounting to focus on the why you are where you are and what happens if you keep going on or change the plan. Now, my experience, sometimes the worst thing that can happen to you is if you're really successful at the start of your business, because the problem is you tend not to look at the detail until sometimes it's too late. You don't know notice a change in your business, and then by the time you do, you're going to have to make drastic changes. Just something to think about. Pay attention to the numbers. So first, financial accounting, you should have just finished that or you should have finished it in your past. It focuses on external users such as creditors and stockholders. The purpose is to help external users to make investing and lending decisions. Must follow GAAP. Primary product are the financial reports. Information is historical data. The information must be reliable and objective, and the focus is on the company as a whole. Provided quarterly and annually, the information must be verified via CPAs. Now, managerial accounting is different. It focuses on internal users. The purpose is to help managers plan, direct, and control. The primary focus is on the future via projections based on past results and new information. Management decides what to report and how. The focus is on the segments of businesses. It provides reports that are on the needs of management, and they do not have to comply with GAAP or be audited. So let's take a look at who would use what information. Internal auditors. They'd use both. Potential shareholders would only get financial information. Loan officers would only get financial information. Managers would get managerial information because they don't really care about the company as a whole in most cases. They just care about their department. The accounting department would care about financial information. Managers of regions would care about managerial. The IRS would only care about financial. Current shareholders would only get, again, financial. Wall Street would only get financial. The controller would get both. Board of directors would get both. SEC would only get financial. And an external auditor like the IRS would only get financial. And that's all they'd care about. Because managerial accounting has a lot more estimates and what ifs. Now, the manager's three responsibilities are planning, setting goals and objectives, directing, overseeing the company's day-to-day operations, and controlling. So planning would be to do a budget. Controlling would be to compare it against that budget. So let's do a little review here. Publicly traded companies must use GAAP. That's financial accounting. Financial accounting develops reports for external users such as creditors and shareholders. When managers evaluate a company, they are doing the control role. Managers are decision makers. Sometimes they're not. Sometimes it's people at the top and the managers just have to go along, just as an aside. Financial accounting provides information on the company's past to external users. Managerial does not have to comply with GAAP. And choosing goals and the means to achieve them is planning. Managerial accounting systems report on various segments, and financial accounting provides the statements for the audits. Now, ethical standards, this has to do with the, now it is, if you're going to go into managerial accounting, you should get your CMA, Certified Manager Accounting. I think that does help. And of course, it tries to say that you have to comply with these standards of competence, credibility, and integrity. Sarbanes-Oxley came out because of CPA firms not doing what people thought they were doing. And a lot of it had to do with off-balance sheet financing. And now they're called SPACs, special purpose interest entities. This is what created problems with Enron and WorldCom because they allowed them to set up these companies, and because of the rules associated with consolidated financials, they were able to hide a lot of their losses. So they came out with Sarbanes-Oxley, and it kind of brought a little more. I'm not sure they did much with this. Now, let's take a look at the terms and see where they apply. Credibility, integrity, confidentiality, and competence. Now, communicate information fairly and objectively would be credibility. Communicate professional limitations that would preclude responsible judgment, credibility. Mitigate actual conflicts of interest, integrity. Provide decision support information and recommendations that are accurate, competence. Abstain from engaging in or supporting any activity that might discredit the profession. Now, this is all part of being a certified financial manager. Provide all relevant information, be credible. Inform all relevant parties would be confidentiality. Perform professional duties in accordance with relevant laws would be competence. Refrain from engaging in conduct that would prejudice carrying out duties. Integrity, report any delays or deficiencies, credibility, and refrain from using confidential information for unethical or illegal advantage, i.e. stock tips, confidentiality. Now let's look, the last thing we're going to do here is a cost-benefit analysis. So we are faced with the pressure, which is actually true, having to pay $15 for minimum wage at a fast food company. So we're exploring the possibility of replacing the workers with robots. Now, one robot can do the work of 30 workers, and each worker typically spends 50 hours per year on the process. Each worker would earn $15 plus payroll taxes of 8%. The robot has an estimated cost of $9,000 plus $1,500 delivery. Annual cost to operate the robot is expected to be $2,000. So, we're going to do the cost analysis, and we're going to decide which is a better decision. Okay, what are the benefits? Of course, we're going to reduce the number of employees so that we can save $22,500 and the wages that we pay on those. And then we're going to subtract the cost of the robot, and according to this, we would save $11,800. So if we were to just look at that, it looks like we should get the robot. The only problem is a lot of times what happens is the people that were doing this work just find other things to do, and you don't get rid of anybody, plus you now have the robot. So that's just my experience with this type of activity. And this concludes Chapter 1.